Welcome everyone to today's webinar where we share how you can directly purchase direct term insurance on FSMOne.com and the considerations behind such an insurance plan. To also complement term insurance, we'll be sharing about the strategies that can help you buy term and invest the rest. Join us today are Joe Lin, Director of Investment Advisory at IFA's Global Markets, Puan Wei Ning from IFA Singapore's insurance team, as well as Ron Ng, our Investment Advisory at FSMOne Singapore. So now I'll pass the time over to Joe to share about the importance of term insurance and how it can be beneficial for you.
Okay, so very good evening, everyone. Thank you very much for taking the evening to spend time with us. Yep, so I believe this thing about insurance in general is a topic that not many people would usually be interested in. About 15 years ago, when I first came into this industry, one of the first thing I was told is that nobody wake up thinking to buy insurance. Which I believe to today it's still very much true. But I think that the whole market space has changed quite a bit. And that's why I think today, one of the things that I really wish to share with everybody, it's how term insurance is a lot more relevant today. Yeah. So I believe many of us, through the various channel, whether it's TV, online, see many different products with different coverage, and all these can be very confusing at times. There are many different aspects of our portfolio that we will be concerned about, whether it's our retirement, our families, medical protections, and many different aspects that we need to plan when it comes to insurance. And all these can be very challenging, right? So we know that there are many different kind of coverage, whether is it a whole life plan that's paying for 99 years, or your limited pay whole life plans, your investment link policy. And in terms of term insurance, you have your renewable convertible term plans, you have your decreasing term, or also known as your mortgage term. There's also group term insurance. And there are so many different scopes of coverage, from death to disability, disability income, your hospitalization, etc. Right? So all these policies, different coverage, how much do we need and what should we be getting at what point in time? I guess one thing that many of us may already have experienced is that insurance can be expensive and it's a long-term commitment. So it can either be very helpful, or it can actually also be a drag on your cash flow if it's not being planned well. So all this being said, perhaps now just a very quick run through of myself. Have been practicing in back then called Independent Financial Advisory, IFA, which after a few years, MES told us to take away the word independent, because many FA firms are not that independent, because we do take incentive, etc. But I have been practicing on platforms that does have various insurer. And back then, when I first joined, that was a period where we were transiting from mostly tied agency practitioner to FAs, where we have the main edge that we have is that we moderate across many different insurance company to help our clients find the best product. And I think by today, this is already something that's a norm, where we believe that many advisors should have access to many different insurance products to find the best solution for our clients. But yet, unfortunately, I believe that's still something that's very lacking. And we do see MES putting a lot of effort to help clients get better advice in the market. So today, I guess the real thing that I will really hope to share across with you all are the trends in the market that I've observed in the last 15 years. And more importantly, what are some of the actionable things that yourself and your family can do, taking advantage of these trends? So I believe many of us, when we look at insurance, will be thinking about what are the best products out there in the market and how to best structure your insurance portfolio. I would like to stress that the one golden question that we should always ask ourselves and constantly review is, why are we buying insurance? What will be the primary concern that we are trying to tackle to better mitigate what kind of risk? Then we will be able to decide what kind of strategy, and therefore look into what kind of policies can best suit in that strategy. And I think something that becomes more and more important is whether this strategy, these policies, are they future proof? Because we know that the market is constantly changing. Our hospital policies, the policies that government have implemented across for us, whether is it your MediShield Life, your CareShield Life, all these are constantly changing the landscape, our market space. Therefore, this future proving of your policies, of your portfolio, is getting more and more important. Okay, so the market trend part one that I would like to share is that on one hand, we do see that insurance policies seems to get more and more complex with a lot more features. Whether is it like your GIA, which is a guaranteed issuance of more insurance coverage upon milestones like graduation, getting married, buying your first property, etc. There's also these days like your multiplier from 0.5 times to 9.5 times, depending on your insurer, right? There is also even coverage that mother can transfer to their newborn baby when the baby is born. So all these might seem to indicate that, you know, whole life policies are getting more and more complex. And in terms of the scope of coverage, the last decade, we have seen disability income, we have seen early CI coming to the market, and very likely over time, we will see that the scope of coverage get more and more defined with, for example, more conditions that we cover for early CI. So yeah, just now I also mentioned that the terms and condition that our insurer have, that means the definition of CI, for example, will get more and more defined, so that this part would, I would say very quickly, is kind of a double-edged sword, whereby from one perspective, we can see that it does seem to get more difficult to claim. But at the same time, from another perspective to quickly share across, is that this more defined terms can be beneficial, because from consumer perspective, that means that I can now know clearly under what circumstances I can claim and cannot claim, rather than the ball being in the insurer's court. Okay. I think on the other hand, we have also seen that there are many insurers coming out with policies whereby the insurance coverage is simplified. The administration, underwriting of it is also simplified, whereby they cover more specific risks with lesser questions we need to answer. The premium is also lower because of the specific risk. So things like cancer care, which we know is the #1 threat in Singapore, which statistically also shows that this is the condition that many people claim for CI or thereafter leading to death. So cancer care actually started many years ago with our insurance companies. But these days, we also do see insurers like FWD coming up with cancer care with much more simplified underwriting questions and administration procedures. Okay. So these days, insurance can be also on demand basis, whereby based on changing risk of the sum assured, based on changing risk, the sum assured can adjust accordingly, or based on the changing risk, the premium can also be adjusted. Meaning, which example, if you are a safe driver, whereby with a detection device, insurer can know that you don't take sharp turn, you do not speed and tailgate. With a safer driver, premium can be lowered. So based on lifestyles these days, depending on what the scope of coverage that we have, premium or sum assured can also be changed, adjusted, depending of our situation. Okay, so coming to this term versus whole life, I believe this is a very common dilemma that many of us have, and we'll be thinking which is of better value, which is cheaper, which is more flexible. I must say that there is a cost to everything, and it's only a matter of who is paying and when the payment is due. In our case study later, I want to illustrate how different policy can be suited for our clients. That means what is, or rather how they have really benefited from the structure of the policy. So first case study is Mr. Lim, age 67. He took up the whole life policy more than 30 years ago. The sum assured is $25,000 and he pays about $800 every year. So today, policy has been converted to annuity and there's still cash value upon surrender of the policy. So this is a very typical example because we know that more than 30 years ago, sum assured of 25,000 is a very reasonable sum assured, but definitely not in today's case. But we know that such policies in today's context may no longer sound attractive. But let's really look back at this specific case where by today, Mr. Lim, who has retired, the policy converting to annuity does suit and sit in very well in his overall portfolio, giving him a good passive income because he no longer need the sum assured anyway, right? So of course, we have also seen other cases where client is still contributing, paying the annual premium, but the cash value have definitely grown beyond the sum assured. So in a way, that policy also kind of serve as a savings policy for our clients. Next case study, we are looking at 10 years renewable convertible term plan for Jonathan, age 5, not even into primary school yet. Sum assured of 1 million, and the premium the parents need to pay for the child is only about $600 per year. So this policy has guaranteed renewal of up to age 75. But of course, one thing to note is that every 10 years, the premium will very likely step up, increase. So it's based on the next 10 years cost of insurance that will be aggregated and insurer will inform client on what's the 10 years premium. So of course, in between, the client will also have the option to convert to a whole life policy with the same sum assured or lower without any medical underwriting. So in this case, what is ideal for this child is that, number one, the child can continue to renew or to buy a whole life policy down the road if the child is still in pain of health. But if there is any medical condition, the child can convert into a whole life policy with no medical underwriting, which I believe that is what many parents would want for their children, which is to lock in the pain of health while they are young and healthy with higher sum assured, so that it is this coverage is more future proof for the child. Okay, so if we were to dive deeper into understanding so-called the difference between the whole life and term insurance, one thing that will determine the premium a lot is the mortality cost. That means the sum at risk, or what we call the cost of insurance. So we know that the mortality costs escalate as we get older, which is in proportion to the risk or probability of us passing on, right? So coming to the very first part, when I buy a term insurance versus a whole life insurance, will the mortality cost be any different? I believe we all can agree that definitely there should not be any difference. Of course, it can vary from insurance company to insurance company. But if I am being insured with the same insurer, that means whether it's Income, Tokio Marine, the mortality cost should be the same, right? So if we take into context of, so in this chart, what we see is the green line, the level premium, is where it's aggregated across to age 120, whereas the red line, this mortality cost, you can also take reference to yearly renewable term. Yeah. Okay. So with that in mind, limited pay whole life plan premium will very likely be even higher than this level premium, because insurer will need to make sure that your cash value can grow to enable to cater for the higher mortality costs when we are older. Okay, so if I were to now look at the trend of change, I believe we can agree that with mortality age being pushed further back, over time, this mortality cost should be lower with medical advancement, etc., which we will also go deeper dive later. At this point, I just wish to quickly highlight one thing for many to ponder, which is when we do a level premium, we know that we are also in a way locking in the cost of mortality when we are much older. And perhaps if we can consider breaking aside, that means our whole coverage, our whole planning of coverage to two segments. That means rather than planning all the way from our current age to the day that we pass away, into two segments, whereby one is our covering our prime working age, the other will be for legacy purpose, then probably we may not need to lock in this higher mortality cost, which is the area in yellow. And we know that that is where costs are significantly higher. Okay. That being said, if I were to quickly reference to many of the whole life policies in the market these days, we know that there are the multiplier, which make the policy look a lot more attractive. But these multipliers usually end at age 65 or 70 as well. So that is the component which is very similar to, or I would say that they are kind of exactly like your term plan. And then at age 65, 70, because that's where cost of insurance would escalate a lot higher after that. Second market trends that I want to quickly highlight is the part that I was talking about just now, whereby with medical advancement and in terms of our lifestyle, I believe many of us do go for medical checkup more frequently. Our medical conditions can be detected earlier, and therefore there can be early intervention, right? And I guess especially in the last 2 years with this COVID, many of us have become more health conscious about our lifestyle, whether it's in terms of exercises, in terms of diet. So we know for a fact that over time, mortality age is being pushed back from long ago. Mortality could be 60 plus. Till today, our mortality age would be in a range of 83 to 86 or even longer. So on that note, coming back to the previous slide, we know that over time, the mortality cost should be dropping, meaning which the cost of coverage, cost of insurance over time will get lower. Just as if you were to compare 20 years ago, buying a 100,000 sum assured term plan versus today, buying a $100,000 term plan for the same age of age 40, the cost of insurance, the premium is significantly different. Okay, next part is also to understand the cash value which whole life policy have, right? So what exactly happens to your premium contribution to the insurance company? The premium that you have given to the insurance company will, of course, be invested into their PAR fund, participating fund. And in this picture, you can see that's the past 10 years performance from our various insurance company. So there are good years, bad years. But does this mean these are the returns that you're getting in your PAR fund or into your cash value? Answer is no, because insurer know that they won't get good returns year on year, which is why there is this thing called the smoothing factor. And on top of that, they also have their expense ratio, which is the cost of managing the policy, the cost of investment, of which it also vary from year to year. So with that being said, we know that the returns from many PAR fund policy are more often disappointing than delivering good returns for our clients. And to further elaborate why we know that in the last few decades, our treasury rates have been on a general decline, right? So that would probably be the main reason why our PAR fund product, which have to be mainly in bonds to deliver the guaranteed portion for our clients, have been dropping over time. So we know that gone are the days where our savings interest rate is over 2%, our fixed deposit rate can be over 4%. Third part of the market trend that I want to quickly highlight is based on the things that I've gone through so far. We have seen that insurer have revised the policy illustration projection at least 2 times over the last 5 to 10 years. right? They have either revised their projection downwards or they have increased their premium for the same projections. So more importantly, products like annuities are being removed. Hear me out. I need to really clearly separate or distinct this. We still do have retirement income plans that pay for lifetime, but we really do not have any more annuities like CPF Life, which in the past we do have. But in the last, again, 5 to 10 years, all these products have been removed from the market. And one of the reasons we can tell clearly is that par fund products is struggling to really deliver the kind of high returns for our clients. So on the other hand, looking at both push and pull factor, I believe many of our clients today can agree that market information is a lot more accessible these days. We also have many different platforms providing the convenience, providing our clients the tools and accessibility to participate in the market performances. We also do see a lot more ETF listing, whether is it in specific sectors, countries, your synthetic, non-synthetic ETFs. So these days, investment have become a lot more accessible and convenient for our clients. So on this note, I think it's very important that with the market, all these market changes, we often say buy term, invest the rest. I would also like to stress that this invest by the invest portion, our client should invest properly so that the portfolio can grow healthily. So coming back in a broader scope, I believe some of the factors that our clients should consider when structuring your insurance portfolio will be the first thing, premium affordability, right? But this premium concern, although would usually form the baseline consideration, should be the least of the concern if our strategy and the structuring is well taken care of. I believe more importantly is looking at the scope of coverage, means looking at really what are some of the risks we would want to tackle. Any of the bonus feature, whether is it GIA or in terms of the special medical conditions that the policy cover, is something that really suit our needs. The coverage, are we looking at short-term or long-term? And more importantly, just now I also mentioned, is the whole structuring, the policies future-proof. So flexibility, I think it's something that we should have a heavier weightage over time to make sure that the policies, if it is not that so future-proof, we have the flexibility to switch or change over time. And with this flexibility being said, I think at the end of the day, many of us will not know which strategy or which product will really work out for us until we try it out, until we really put it into action. So if I may quickly highlight, term plan would really be something that suit because there's no cash value, therefore it does not have what we call, as in there's no strings attached in that context. So perhaps to quickly cover another aspect of planning, whereby how much sum assured is required for the different kind of coverage. We have usually a lot of standard formulas available, whether is it online or your advisors may suggest, because these are chartered financial planners recommendation, where it could be a multiple of your annual income, it could be a multiple of your expenses. LIA also have an online calculator that you can reference to look at what's the suggested sum assured. But perhaps one thing that I will want to stress is that aside from looking at your existing liabilities, responsibility, each of us have different preferences, different priorities. Therefore, in a specific situation, we may not end up making the same decisions or having that same required sum assured. So perhaps I will want to go back to the golden question that I mentioned, which is why buy your insurance? And we should really look more deep dive into understanding your specific concerns and your specific situations before determining what's the strategy, anchoring down on the why, so that we do not get distracted by other factors. And I also wish to quickly stress that this part of the why will very likely change over time. To quickly sum up the part about why term insurance is more relevant in today's context is that we can see that there are different term structure for different needs, where you can have 99 years term that would, or even up to 101 years that would cater for legacy and estate needs. There is the flexibility, whereby, like I mentioned, because there's no cash value, therefore there's this like no string attached. So with the lower cost, we can be more efficient with our cash flow. For example, with 5 years or 10 years renewable, we can have quite a bit more savings. And with that, when we manage our own investment portfolio, we can have potentially higher returns compared to what the par fund products can deliver us. More importantly, I believe that we can get higher sum assured tailored to our specific needs. Whether is it, for example, if we are more concerned with cancer, we can load up more in terms of the cancer specific insurances, or if there is any specific components that we wish to have more sum assured, we are not restricted by the structure of the whole life policy. So last but not least, I wish to end off with this portion whereby I still would firmly believe that we should only buy what we need, meaning which we should not be getting higher sum assured because it's cheaper. And although we know that we'll very likely need higher sum assured in the future, and our current health will very likely be better than what it is in the future. But there are many other tangents of considerations. Okay, so if not, I thank everyone for your attention. I would just want to quickly highlight that apart from our usual commission rebate, at the moment, we do have some campaigns with our partners where there are discounted premiums. And we also, if you wish to have a comprehensive portfolio review, do reach out to our insurance team and follow our insurance team's article where we will be sharing more market trends and more insights to planning for your insurance portfolio. Thank you. Next, I will hand my time over to Wei Ning.
Hi everyone. So today I'll share more on FWD, Term Life Plus. It's a simple, swift and seamless way to purchase direct term. So what is FWD Term Life Plus? It's actually a digital term insurance that you can buy directly online. So it's a simple product and you can buy up to 1.5 million coverage. So entry age is between 18 to 60. So the key features of this is that it's actually fuss-free. There's no need for a medical checkup and it's customizable coverage. Okay, so what do I mean by fuss-free? So for traditional term plans, right, actually you have to submit an application and then wait for an interim or official cover to be issued. But with FWD Term Life Plus, your quotation and purchase can be done directly online. So you don't actually have to meet an advisor to do it. So next point, for traditional term, the underwriting process can take up to a month or more, and there's always a lengthy form to fill. But for FWD Term Life Plus, coverage can be purchased in just 10 minutes if you are healthy, and you only need 5 details to get a quote. Okay, so the 5 details you need is actually just your gender, your smoking status, your age, type of plan, and what's your coverage. So after you key in these 5 details, you will come to this page where they'll ask you whether you want to add on riders. So riders are actually coverage enhancers. So if you choose to add on, there's a choice to add on total and permanent disability rider, a critical illness rider, which covers for up to 35 critical illnesses, or you can also add on a waiver of premium. And then when you click apply, you can actually use our promo code IFAST to get additional discount on your first year premiums. So the current promotion is actually shown on the banner here. So you'll be able to get up to 30% off. Okay, so then you'll be redirected to FWD's website to continue and complete your application. So don't worry, all your details are actually pre-filled into FWD, and you'll be able to see that the discount is also applied. And then you can just proceed to complete your application there. Okay, so the second feature of this product is that there's no need for medical checkup. So if you're healthy, all you have to do is actually just answer a few simple questions. You just tick a few check boxes and then you can make your purchase. So for customers aged 50 and below, you can actually buy up to 1.5 million sum assured. And if you're above the age of 50, it's up to 500,000 sum assured. Okay, and the third feature of this is that actually there's customizable coverage. So this, you can actually choose between a fixed or renewable plan, and you can choose the coverage amount you want. So this will range between 50,000 to 1.5 million. And as mentioned just now, you can also add riders to further enhance your coverage. Okay, so since this plan can be purchased on your own without consulting an advisor, how then should you choose a plan? Okay, so some coverage tips to share. So when deciding how much you need to buy, maybe think of it like this. Think of how much coverage you actually need. So this, you will have to calculate it. And then you can actually take the, how much coverage you actually need is the total coverage amount you need minus whatever you already have. So for example, you need 1 million coverage, but you already have 200,000 cover. Then your necessary coverage is actually only 800,000. Okay, the next thing to think about is whether you can afford it. Is the premiums for this plan within your budget, and can you comfortably afford this? So if you feel that this will be tight on your pockets, then actually these premiums are too high for you. And the last thing to share is, can I enjoy greater savings? So for FWD Term Life Plus, FSMOne actually offers 30 to 45% commission rebates for this. And this is in line with all other insurance plans that we actually offer our clients at FSM. So commission rebates amount is actually tiered according to your account status. Okay, so maybe you are wondering where can you find this on FSMOne. So you just need to click onto Insure, and then this can be found on 2 places. One is on the insurance homepage and one is under insurance products. So under insurance homepage, there will be this banner at the bottom. If you click onto it, it will actually lead you to our product page. Alternatively, you can click onto Insure, Insurance Products. And when you see this button on FWD Term Life Plus, you can click onto it, and it will also lead you to our product page. Okay, so if you're interested, you may also wish to scan this QR code. And let me just give you a demo of how this actually looks. Okay, so this is how our product page actually looks. So over here is the 5 details you can click to generate your quotation. You can just click and choose according to your profile, your personal profile. And then actually, if you scroll down, you will actually find that we have some features here. So we actually do elaborate on what are the product features of FWD Term Life Plus, what are the differences between fixed term and renewable term. And we also do share what each policy is actually available for. So you also can look at our video, and we do have explanation on what coverage these riders include. Okay, so y'all may go and try this page. Okay, so y'all can actually scan this QR code if you are interested in seeing this page. Okay, so some common questions that you may have about this FWD Term Life Plus. So just to share, FSMOne does not process the payment. FWD will handle this, as this policy is actually underwritten by FWD Insurance. FSMOne is just a distributor. Okay, and this plan can be purchased on FSMOne, or you can also purchase directly on FWD Insurance with the promo code IFAST. Okay, and this policy, like we shared previously, this policy will be eligible for commission rebates. So you will get 30 to 45% commission rebates, which will be tiered according to your account status. And now we're running an exclusive promotion for FSMOne clients. So from now until 17 April, you can get 30% off your FWD Term Life Plus. All you have to do is key in your promo code IFAST, and this promotion will automatically be applied. Okay, just to share, currently on FWD's own direct website, they are only giving 15% off. So if you purchase through FSM, you actually get a better discount. Okay. And with that, I've come to my end. I'll pass on to Ron.
Yeah, so good evening once again. I'm Ron from the FSM Investment Advisory Team, and thanks for staying with us. So for the final part of today's session, I will be sharing some tips on how, what, and where you can start your investment journey if you have not. So knowing what are your options is literally your first step to investing, because it is always important to know what you are buying into. Then comes how. Is it better to dollar cost average or time the market to perfection? Last but not least, where to invest, like which region or sector provides the best return. So first up, one of the options that new investors can consider is unit trusts. It is simply an unlisted, actively managed investment portfolio that can consist of stocks, bonds, or both at the same time. Investing in unit trusts allows you to tap on the fund manager's expertise in certain areas. For example, some fund managers have a good track record for picking undervalued stocks in the Asian region or the tech sector. There's also greater flexibility in selecting what goes into the portfolio, which could generate potentially higher returns than benchmark indices. Exchange-traded funds, or ETFs for short, is also an option to kickstart your investment journey. They are similar to unit trusts, as both are investment portfolios that can consist of stocks and bonds. The main difference is that ETFs are listed on exchanges such as SGX, Hong Kong Exchange, or the New York Stock Exchange. It is also passively managed, meaning that the fund managers do not have to pick what goes into the portfolio. Rather, it just tracks and replicates the performance of an index, like the Straits Times Index, Hang Seng Index, or the S&P 500. It generally costs lesser to invest in ETFs than unit trusts, as investors do not have to pay fund managers for their analytical work like for unit trusts. Also, as the ETF tracks a single index, the risks would not significantly exceed that of the underlying index, as there is greater certainty over the securities that goes into the ETF. An in-house solution that we invest, where we invest on your behalf, is My Assisted Portfolio Service, or MAPS for short. Generally, MAPS is suitable for new investors who are unsure of what to invest in, or individuals who are just too busy to monitor their investments. Of course, there are no restrictions on who can invest in MAPS as long as you have an FSMOne account. MAPS lets you leverage on FSMOne's analysis and fund selections, which includes both unit trusts and ETFs. There are also 5 different portfolios to choose from, ranging from conservative all the way to aggressive. So after knowing your options, next question new investors might have is, how can you start? So the quick and easy way would be to invest through a regular savings plan, where you invest a fixed amount of money every month. Good news is the 3 products we went through earlier are all available to invest via RSP. So you might ask, so what's so good about investing through RSP, right? Well, firstly, RSP forces you to save or invest in a disciplined manner, not letting emotions get in the way of your thinking. There's also no need to invest an initial capital. We can also make use of dollar cost averaging to ride out market cycles, as illustrated in the graph you see on the right. And having no lock-in period allows you to withdraw your savings in case of emergency. You're also able to adjust your monthly contribution amount. So if you had a pay raise, you can increase it. And if you need to allocate funds for other expenses like housing loans, you can decrease it by just keeping it to the product's minimum investment amount. So when it comes to portfolio strategy, there's absolutely no right or wrong when it comes to like where to invest in, right? The key outcome is to achieve returns that are significantly better than your fixed deposits or the endowment plans, while still keeping to your risk tolerance. For investors who are just starting out, it is vital to understand the trade-off between risk and return, how investment horizon affects your portfolio return, the importance of asset and geographical allocation. So before we wrap up, we'll also share some tips on crafting a portfolio to cater to different investment objectives. So when it comes to investing, right, there's always a trade-off between risk and reward. Investments that generate higher returns usually entails higher risk, be it a plunge in investment value or potential total loss of capital during unfavorable market conditions, such as the global financial crisis. Higher returns are meant to compensate investors for taking on higher risks. Therefore, we need to understand that the best investment differs for each individual investor, and that the best investment is often the one that is able to help you achieve your expected return within your risk tolerance. And before you start investing, here are some questions you should think about, like how much I can invest, how much can I bear to lose from my investments, how long can I stay invested, why do I need to invest the money, and when do I need the money? And speaking of when do I need the money, we find that many investors tend to underestimate the time horizon that they can afford to stay invested. Time is one of the most important factors when it comes to determining your portfolio's asset allocation, because historically, illustrated in the chart below, we can see that the shorter your investment horizon, the more likely you are to lose money while investing. Your investment time frame will help you to decide what the weightage would be like between equities and bonds, which in turn affects whether a balanced or aggressive portfolio is more suitable for you. So if you do not need the money in the near future and can keep it invested, adopting a more aggressive approach will generally yield better returns since you have the time to ride out market cycles. Portfolio diversification is also something that we advocate for our investors. Diversification can come in two forms: diversifying across different asset classes and diversifying across different regions or sectors. Traditionally, stocks as an asset class have generated higher returns across longer periods, even though bond funds are unable to achieve the kind of returns similar to equities. They help to reduce portfolio volatility. Historically, this table shows how markets have performed over the last 10 years. How much to devote to stocks and bonds will depend on your risk tolerance, investment time horizon, and investment objective. A portfolio consisting of both bonds and equities has proven to be more resilient in weaker market conditions and achieve a better risk-adjusted return in the long run. That is why we suggest having a good mix of equities and bonds based on your risk profile. For a start, if you are uncertain about how much to allocate into each asset class, you may refer to this table for some form of guidance. I'll leave this page here just for a few more seconds in case you wish to take a screenshot. Again, in terms of performance, there's really no consistency as to which region always comes out on top. So we believe in the merits of having a globally diversified portfolio, as we find that diversification helps to mitigate abrupt market swings. This is because different regions experience varying economic growth rates, and a globally diversified portfolio allows you to capture growth opportunities in each region without worrying about over-concentrating your investments on a single region. So we like to use the soccer team analogy to advise investors on how to construct their portfolios when starting out. And I know this formation is outdated if you are a soccer fan, but do bear with me, the same principles still apply. So like all soccer teams, a goalkeeper has to be played, and drawing the same parallel, we have to keep some form of cash for liquidity in our portfolio, be it in the cash account or money market funds. The defenders and midfielders tend to be the engine of the team. They prevent opposition from scoring and also progress the ball forward towards the goal. Similarly, bond funds reduce volatility in the portfolio, and equity funds generate fair returns over time. Finally, strikers are usually the focal point of the attacking play. Like a striker, country or sector-focused funds add finishing touch to the progressive play. And during matches, managers tend to substitute on more defenders if they are winning a match and want to protect the lead. So same gameplay can apply to your investment portfolio. If you are sitting on healthy and comfortable returns, you may consider switching out sector-focused funds to short-term bond funds, for example, to take profit on your investments. So before you invest, think about your investments as buckets. So this bucket strategy is a method of prioritizing your investment goals based on their level of importance and allocating your investment portfolio accordingly. For example, having enough for daily living expenses is typically the most important goal and considered a need. On the other hand, buying a Rolex may be of lesser importance and can be considered a wish. Once you establish your priorities, you can then review the timing of your goals and organize your investment assets to separate buckets. Each bucket's assets get invested appropriately, taking into account the time until you need the money, while still maximizing the potential for growth. As a rule of thumb, maybe the first bucket, which is used to build up your emergency savings, can be invested into money market funds. Second bucket for short-term liquidity can be invested into short duration bonds. Third bucket, which is linked to specific investment goals, can be invested into maybe balanced funds. And fourth bucket, designed for long-term growth, can be invested into equity funds. So if you wish to have a chat with us regarding how to construct your portfolio, or just hear our latest views on market outlook and market conditions, just feel free to reach out to us via any of these channels. And finally, thank you for taking the time to attend our webinar this evening. And just to let everyone know, if you have not already heard, our ongoing promotion of 0% processing fee for ETF RSPs will continue running from now to the end of the year, which means that now is the best time to start your investment with us. I'll be sharing the link to this promotion in the chat. So please visit the link for more information on this promotion. And thank you once again. I'll hand the time back to Sarah.
We can probably end the webinar off here. So I'll just reiterate again what was shared. So some of the promotions that we have shared. So for example, Ron has shared our 0% processing fee for ETF RSP. The promotion is highlighted in the chat function. So if you head on over there, you can actually copy and paste the link to find out more information about it and how you can enjoy this promotion. And for the FW Term Life Plus product that Wei Ning shared earlier, it's also pasted in a link below in the chat function. So you can go over there to also see how this product is, how you can make use of this product and how you can fill in the form and get a quote for the term insurance. So yes, so I think that's all for this webinar. So once again, just thank everyone for joining us this evening. I'll be leaving the Zoom window open for a while, so you guys can have some time to copy and paste some of the links that we have shared. So with that, I want to thank everyone. Thank you.